Welcome to Morning Brief. I'm Brooke DiPalma. Let's get to the three things you need to know today. Earnings season is in full swing. General Motors out with results. The automaker expects profits to jump up to $2 billion this year. GM also expects to return that capital to shareholders. The company is planning higher dividends and more paybacks. And we're watching earnings from Boeing. The company's turnaround is in place with quarterly sales jumping 57%. Boeing also posted a second consecutive quarter of positive cash flow. But the latest results, well, they don't seem to be impressing investors today, with shares down about 2% in extended hours. Finally, United Health forecasting its first annual decline in revenue in more than 30 years. The insurer is struggling to rebuild confidence with investors after a stunning fall last year. The company is also facing new pressures. The U.S. proposed holding payments to private Medicare plans flat next year. That news hitting the stock before this morning's results, which added more pressure on shares. Shares now down about 16%. And let's get a quick check on stock futures. Right now, all three major indices trying to hold on to some momentum here. We are seeing the Dow fall, the United Healthcare falling lower, down about 0.6%. The S&P 500 trying to hold on to some momentum here, up about 0.2%. And the Nasdaq really leading momentum here, up more than or around 0.6%. Once again, to kick off this Tuesday's trading session. And this all really comes as on the trade front, the EU and India have reached a free trade deal after nearly 2 decades of negotiations. The agreement comes as the two powers look to offset President Trump's trade policies through economic ties. Now, European Commissioner President Ursula von der Leyen posting on X that they have, quote, concluded the mother of all deals. Joining us now is Seema Shah. She's Principal Asset Management Chief Global Strategist. Seema, thank you so much for joining us this morning. Lots to get to. First, we're waiting to hear from a response from Washington this morning. What could it be? What could we possibly hear from the administration in response to what's said, this mother of all deals here?
Well, it's going to be interesting how they respond. But I think just looking at the reasons for Europe and India to have this trade deal, I mean, firstly, this has been a long time in the making, so it doesn't come as a surprise. But I think it does tell us that you could see increasing number of alliances between other countries around the world as we get used to this kind of multifaceted world where economies can't be completely dependent on the US anymore and really need to start thinking about their trade relationships with other partners.
Now, Seema, this also comes a week after we heard those threats on the EU over the potential, buying agreement to buy Greenland. We then heard the framework of a agreement has been made, and President Trump pulled back those tariffs. You say that Washington's growing reliance on tariffs as a geopolitical tool suggests here that trade policy volatility will remain within this administration as part of the framework or feature of the investment landscape. Do you think that this sort of plays out into the future narrative? Will we continue to hear different threats, tariff threats, after we heard that they're making this other trade deal on the sidelines here?
Yeah, I think we can expect this to be part of that geopolitical playbook, tariffs being repeatedly used. We've seen them being utilized even after last week to a number of other countries. But I think the key thing is that markets are really adjusting to this. I think they're learning a number of things. They're learning that firstly, tariffs don't have as much of an impact on growth or inflation as much as they had anticipated, partly because of very strong US profit margins has meant that companies can absorb it. But also that the Trump administration doesn't always follow through with those threats. So I think there's a number of things which are enabling markets to look through a lot of that noise, which has been the right trade. And remember, we have seen this play out last year where we had a number of very serious tariffs being announced, and yet the economy and the market performed very, very well. So I think markets are learning a lot from last year.
And Seema, one of those latest announcements that we got, another tariff threat, was that threat on South Korea, increasing that tariff from about 15% to 25%. Large implications there for automakers, pharmaceuticals. What do you make of that latest threat and how that could fall out into the economy here?
Well, it's interesting that the South Korean market hasn't really reacted very much. I mean, there was a knee-jerk reaction, which was very quickly corrected. As is the case with a lot of these things, we need to wait and hear what the details are. Of course, if they are actually going to be followed through, there could be some impact, of course. a lot of these markets. But ultimately, a lot of these companies have adjusted to the idea that tariffs could come through. They're adjusting their supply chain. So that dependence again on the US is declining. There will be an impact, certainly, if those tariffs go through. But I don't think that they would be as severe as maybe we would have feared this time last year.
And Seema, this is all happening as we're set to get some earnings from major U.S. companies, Microsoft, Meta, Apple, Tesla this week alone. You say that earnings remain the anchor here. Walk us through how investors should be going into these reports and what they should be listening for.
Yeah, sure. And I think to your point, we've had an incredible run up for markets. Valuations are quite stretched. So when we're looking at how total returns are going to perform for this year for equity markets, it really does come down to earnings growth. So that has to be key in terms of predicting where things are going to go. So specifically for these big tech companies, there is increasing dispersion. Investors are looking at the tech company, the tech trade, in a slightly different idea, suggesting that there's more focus on the balance sheet strength, on cash flows, and of course, what are the intentions on AI capex and how it's going to be funded. So we're expecting to see a lot more dispersion within the sector. That doesn't mean that the AI narrative is being challenged very much. It just means that investors are maybe starting to think through what are the differences between the companies. It's going to be very important how these tech companies perform, how their earnings announcements go. That's really going to set the tone for the market. But I would also say that, look, we are looking at a really strong macro backdrop for the US. That does suggest that earnings growth, not just in the tech sector, but along a number of different sectors, should be performing well this year. So from our perspective, tech can do well, but also we do think that there's a potential for broadening out to other sectors and actually to other countries for that matter too.
And Seema, on top of all this, we're also expecting to hear from Fed Chair Jerome Powell on Wednesday afternoon, expecting a decision on the latest potential rate cut. It doesn't seem like they're expected to cut rates here, but you say that eventually we could see additional support from the Federal Reserve. How should investors be going into Wednesday meeting, and what are some key things that you would like to hear from Fed Chair Jerome Powell?
Yeah, I think there's a lot of focus on tomorrow. Just wondering how Jerome Powell is going to be, if there's any kind of response to the DOJ probe. We're not anticipating Powell to really talk much about it, but really to be focused on the interest rate decision. The market is, I think, predicting with zero chance of a rate cut tomorrow. Certainly that's our perspective too. But we do think that there'll be talk a little bit about the labor market inflation, maybe taking on a slightly more positive tone on the economy and the labor market. But we do think that as the year progresses and maybe some of the tariff caution around inflation does start to fade around mid-year, that would open the door for one or two more rate cuts. So I think it's about keeping that door open whilst also conveying some optimism about the strength of the US economy.
Fed Chair Jerome Powell in the past has also weighed in on productivity gains, kind of alluding there to the impact of AI. Do you think we could hear anything on that front as well?
Certainly I think this is going to be a key topic for the Fed over the coming months and years. Now, I think even if he doesn't mention it himself, there'll certainly be a question around it because the AI thematics and around the productivity gains, the impact to labor market inflation is going to be so key for central bankers to try and navigate when it comes to their policy decisions. Already we're seeing evidence of productivity growth in Q3 and Q4 already. So certainly that's a part of the narrative. It's probably quite early days for the Fed to be basing their policy choices on it right now. But I would suspect that this is a subject of a lot of research for the Fed, for the Bank of England, for ECB, for a number of central banks.
Seema Shah, thank you so much for joining us this morning. I really appreciate your time.
Thanks.
Coming up on Morning Brief, we bring you today's top trending tickers as we count down to the opening bell. Now time for some of today's top trending tickers. We're watching health insurers, Pinterest, and Corning. First up, health insurers. Many are under pressure this morning as the U.S. government is proposing to keep private Medicare payments flat next year, which is well below what analysts and investors anticipated. According to the Centers for Medicare and Medicaid Services, payments would rise by less than 0.1% on average next year. The biggest names in the industry, United Health, Humana, CVS, and Centene, are all down sharply ahead of the open. Next, Pinterest, the social media platform, under pressure as it announces a restructuring, including laying off up to 15% of its workforce. That amounts to roughly 700 jobs. Pinterest saying the restructuring will support transformation efforts, including reallocating assets to AI-focused roles and focusing on AI-powered products. Finally, Corning, that stock jumping on a deal with Meta. The longtime Apple supplier will produce fiber optic cables for Meta's AI data centers, and the deal is worth up to $6 billion through 2030. In an interview with CNBC, CEO Wendell Weeks said the company expects AI hyperscalers, including Meta, Amazon, Alphabet, and Microsoft, to be its top customers next year. Meanwhile, General Motors topping fourth quarter earnings expectations and approving a $6 billion share repurchase authorization. Senior Autos reporter Prasad Manian spoke to GM CFO Paul Jacobson. He joins me now with a look at that conversation. So, Pras, what are some of your top takeaways that you got from this call?
You know, we talked about that share buyback plan, and we talked about sort of pivot with EVs, and they took a big charge on that and how they were sort of seeing that business kind of operate in the future, and also how Paul viewed the U.S. auto industry as a whole, talking about a 16 million seasonally adjusted annual rate of cars. So that's actually kind of positive. But we started off talking about tariffs and how that was going to affect their bottom line and guidance. So here's what Paul had to say. Talk to me about how Q4 progressed, and which sort of leads us into 2026 and GM's projections there. Improved compared to this year, though modestly so.
Yeah, so 25 was quite the adventurous year as we started with a lot of uncertainty around the tariff environment. And as tariffs stabilized, we implemented the plan that we had begun working on as long ago as November of 24. And I think the team did an excellent job of dealing with the adversity and the challenges that the year presented to deliver the results that we did. And that culminated in what I think was a really strong Q4. Picked up a lot of share and continued to see that success. So that turns into the profitability that drives the cash flow engine that allows us to continue to allocate capital in a way that's friendly to shareholders. And I think that topped off what I'm really proud of what the team accomplished in 2025.
So I know that I think CEO Mary Barra wants to return to 8 to 10% EBIT margin there in 2026. You mentioned the tariff exposure, $3.1 billion, I believe, this year, and you're kind of seeing the same next year. Is there any improvement from the White House talking about any kind of improvements there with tariff rates there, or is it still going to be what you think happened this year is going to be the maintain in 2026?
Well, I think when you look at our net tariff exposure, which is our tariffs less our self-help initiatives that we've talked about, we have three pillars: go-to-market, footprint changes in manufacturing, and then ultimately fixed cost reductions. We were able to offset more than 40% of our total tariff bill in 2025 by just going to work and figuring out what we do as a GM team. And more of that is going to continue in 2026. So, we're very comforted by the administration in terms of their willingness and to work with the U.S. auto industry. I think they realize how incredibly important it is to the country and to our economic health overall. And I think they've been fair in terms of how we have progressed through this and how they've treated it to make sure that the industry isn't put in a difficult position where it can't compete globally. And I think within that framework, we've been able to cut our own path that I think works well for us. And getting back to 8% margins in 2026 is probably about a year to 18 months ahead of where I think investors thought we would be. So that progression has been really good for us to get back to that range and really do what we do.
That leads me to the $6 billion share authorization plan and the dividend hike as well concurrently. Are you able to do that, or GM able to do that because of the fact that you have that tariff exposure, there's more certainty there with that?
So we paused our share repurchases about a year ago as we went through that uncertainty, not knowing what that tariff landscape was. But as soon as we got that certainty, we immediately got back into what we've been doing in that balanced allocation of capital. So we don't see any reason to change that. While valuations have gone up slightly, we're still at a discount to the industry, and we're still one of the most valuable stocks out there in terms of free cash flow yield. So we still have a double-digit free cash flow yield. We feel like the stock is undervalued, and that's why we're able to continue to use our capital and free cash flow to go back and allocate some of that back to shareholders.
So you're generating cash there on the auto business, but then also there's the EV side of the equation is you took a $6 billion hit there in the Q4, I believe, and you might see some hits in 2026 as the business reorient itself. But also, I read that the losses are sliding; they're coming down in that business. How do you turn the tide there? And I know Mary talked about how when people go with EVs, they don't want to turn back. So you have some momentum there. How do you keep it going with EVs with the loss of the tax credit in Q3 of last year?
Well, I think the first thing we had to do, and while it's never great to write off capital, sometimes you just have to do it, and that's where we've kind of hit the reset button. If you think about where we've been for the last few years, we were tooling up and scaling up to produce 1 million EVs a year because that's what the government was requiring under the prior administration. So with the changing regulatory environment, we see a much slower path to EV adoption, but we do see a path. So what this is allowing us to do is to continue to drive cost savings and improvements into the vehicle profitability, what we're doing with the new battery technology coming on in 2028 with LMR, which has all the energy density of high nickel, but at a cost that's more like LFP. It's going to allow us to save thousands of dollars in the vehicle. So we can do that on lower volumes going forward. As far as demand goes, I think it gives us time to get the charging infrastructure up and ultimately get people more accepting of EVs, because when you look at the product offering and what it can do for a consumer with the technological capabilities, et cetera, it can be a superior driving experience. But people are going to have to test that, and we're going to have to get over some of the charging anxiety issues, get more chargers out there, and that's going to continue to drive demand. And I think we can be in a leadership role, especially now that we've reset our capacity to be more efficient going forward, and that will save us thousands of dollars per vehicle going forward and ultimately help us back on our journey towards profitability in EVs.
New Bolt EV coming out, I believe, this year too, at a cheaper price point as well. Does that help you sort of get back to 100,000 EVs a year? Is that possible again, or is it going to be a slower game plan?
Well, I think we'll probably do about 5 to 7% EV adoption. We think that's where the trend lines were before the IRA and the consumer tax credits came into place, and that's kind of where we've settled out. Although it's been a little bit noisy since September, and we expected that. So I think over the next few months we'll get a better idea of where demand is, and I think it'll steadily go up there. When a customer drives an EV, we see about an 80% retention rate where they say that they want an EV for their next vehicle as well. So it's going to take a little bit of time, but we've got the patience, and I think we've got the capital to be able to do it.
I see that 01X behind you, and on the flip side, the powerful V8 engines there. So, I want to talk to you about gas-powered cars building in America. How do you increase that exposure to the U.S. Manufacturing and still keep costs down? And by the way, you're still seeing a $16 million SAR this year. Is that going to be driving that? Is it all about gas and hybrid cars?
Well, obviously with the regulatory environment, it allows us to sell more of those ICE vehicles that consumers want and demand. And I think we've got a great franchise, all across the board for all price points. Last year, we sold over 700,000 vehicles with a price tag less than $30,000. So it's been an incredible run, and I think our portfolio really speaks to every customer wherever they might be on their price points, and that gives us a leg up, I think, on the industry and allows us to pick up some share. So that's going to continue. And when you look at driving that cash flow, what it's allowing us to do is reinvest back into America. So we've got about $5 billion of capital that we've allocated to onshore production. And we think by the time we get to 2027, when many of those projects come online, we'll be producing nearly 2 million vehicles a year in the United States.
So the stock up 5-6% here. The call ongoing. I guess investors like what they're hearing about the game plan there. The guidance was a little modest, but I think that given where we are with tariffs and the auto industry in general, I think investors are sort of buying GM's playbook here.
Yeah, and the uncertainty lingers, but they're willing to stay on for the ride, it seems like, quite literally. Thank you, Pras. I appreciate your time. And coming up on Yahoo Finance Opening Bid, our own executive editor, Brian Sozzi, joins us now. Brian, I'm excited to join you for the show. Talk about what we're about to talk about.
Look, I'm excited that you're excited. And when I think GM CFO Paul Jacobs, he didn't want to tell Pras, but that car behind him, that was actually mine. I ordered it a month ago. That thing's getting shipped right to my house. I'm so jacked up. But on this show, we're going to talk about the boom in precious metal prices. That continues to be top of mind for me. Also, big tech. It's going to be a big week of tech earnings there, Brooke.
And Brian, there was no robot plower being used yesterday at your house?
Nah, I don't have 5Gs to drop on some machine that's going to shovel my snow. I just do it with these, Brooke, right here. This is what I got.
That's because you bought the GM car.
Yeah.
All right.
Oh.
Well, that does it for Morning Brief. Much more ahead on Yahoo Finance.